Welcome to today's webinar, Opportunity Zones for Financial Advisors. I'm Jimmy Atkinson. I'm the founder of OpportunityDb and host of the Opportunity Zones podcast. Before we get going, just a quick legal disclaimer. This is not legal advice or tax advice or investment advice. Please consult your advisor before making any investment decisions. Let's start with opportunity zones and who can invest in them. Let's weed out anybody who may not supposed to be here. My guess is everybody who's here is here for the right reason. But really this tax incentive only applies to US taxpayers with capital gains. Typically, you will need to be an accredited investor in order to invest in a lot of the funds that are open to investors and accepting capital. You don't necessarily have to be an accredited investor, but you know, I'd say 99% of the time you're going to fall into that bucket, or you're going to need to fall into that bucket. This benefit really applies primarily to high net worth and ultra high net worth investors, and family offices is who this benefit is most directly beneficial for the vast majority of the time. And we're talking about a capital gain tax incentive program here, which is going to apply primarily to folks who have large amounts of capital gains. And I would say $50,000 is probably the floor before you want to even consider making an investment of this type, just because of some of the complications involved with it and the holding period. Speaking of the holding period, that's my next bullet point here. These qualified opportunity funds and opportunity zone investing does require patient capital. There is a 10-year holding period that you have to achieve in order to receive the full tax benefit of the program. That's a very important thing to keep in mind. And then also you're going to need a little bit of liquidity to pay a tax bill in 2027. That may be subject to change. There's some pending legislation on the deck, which I'll get to a little bit later in the presentation today. So with that said, and now we're kind of off and running with the presentation today. We've discussed who can invest, who is this type of incentive appropriate for, who is this new type of investment vehicle appropriate for. We're going to get into the agenda here. So I have laid out, I have this laid out as what I think is oftentimes referred to, I refer to it as this, the greatest tax incentive ever created. So some of the things we're going to cover in today's presentation, we'll go over the policy background, why opportunity zones came into existence, go over some fact and figures and some technical terminology, and then we'll get into the meat of the tax benefits themselves. And spoiler alert, and I have this highlighted because this is the most important part. We're talking about unlimited tax-free growth here. It's really kind of akin to a super Roth IRA. You can think of it as that in some ways. We'll do a comparison of another popular type of tax mitigation program, the Section 1031 exchange and Delaware statutory trusts. We'll compare those types of investments with opportunity zone investments. There's a lot of similarities, but there are a lot of differences as well. We'll touch on state tax conformity. This is a federal tax incentive program, but most of the states conform, although there are a handful that do not, and you need to watch out for. We'll have a little overview of qualified opportunity funds, what they are, some of the compliance requirements, and then finally we'll do some legislative updates and a marketplace update to see, how much money has been raised by these types of funds so far. And then finally, how to invest or how you can have your clients invest in opportunity zones. So in order to kind of give you the context on why and when this incentive program came into effect, let's rewind the clock to the recovery after the last big recession of 07, 08, 09. We saw during that time period, in the time period immediately following that recovery period, in 2010 and beyond, wealth inequality and income inequality, that gap widened. Wealthy areas around the country recovered quite nicely from that recession. Low income areas got left behind. That's the story that kind of paints the picture of why this incentive was needed from a policy perspective in the first place. So the policy challenge was this: instead of creating another government program, throwing government grant dollars or government tax credits at the problem, throwing more money into these poor areas directly from the federal government and its coffers, how can we, as the federal government, I'm speaking as the federal government right now, although I'm not, how can we incentivize wealthy individuals, that top 1%, top 10%, to invest some of their wealth take some of it off the sidelines, out of the stock market, out of wherever, and invest it into low-income areas all over the country to create new jobs and to increase the local tax base. And the solution to that problem, or one proposed solution to this problem, is opportunity zones. The incentive here includes a tax deferment period and tax-free growth for the investor. And the policy goals, the desired outcome, and the jury is still out on whether this outcome is being affected or not, but twofold: one for the investor and one for the communities themselves. For the investor, we're talking about an investment return plus massive tax savings. And for the communities who are affected by this policy, the actual opportunity zone tracts themselves, this being a place-based policy, these particular communities that were designated as opportunity zones, they're looking at economic revitalization for, typically underserved community that has traditionally lacked access to such private capital. So opportunity zones actually date back to 2015 is when this legislation was first started to be drafted while Barack Obama was still in the White House. And it was initially introduced in bipartisan fashion and bicamerally into the House and Senate in 2017. And it was eventually passed under the Tax Cuts and Jobs Act by President Trump at the end of 2017, his huge tax reformation program. The period, the ensuing period in early 2018 gave the governor of each state, the mayor of Washington, D.C., and the governors of all the overseas territories some time to nominate a certain amount of low-income census tracts, up to 25% of each state's low-income census tracts as opportunity zones. That process unfolded in early 2018 and it's finished now. So there are no new opportunity zone boundaries or census tracts being created. That process completed about 4 years ago. Opportunity zone designations were finalized by the Treasury Department and IRS in July of 2018. So we've really got about 4 years under our belt now with this program since the zones have been designated. That's when the first qualified opportunity funds started raising capital and investors were first able to start putting money to work in opportunity zones. Although it took another roughly 18 months before the IRS issued final regulations on the program. So there was a lot of uncertainty in that first year and a half period. This is also a perishable incentive, and we've already had a couple of incentive tranches expire. We had one set of benefits expire at the end of 2019, and another set of benefits expired just at the end of last year, at the end of 2021. Although I should note, and we'll cover this a little bit later in today's presentation, the main benefit, that tax-free growth within the Qualified Opportunity Fund, is still available for many more years to come. Really what was removed, I like to compare it to a hot fudge sundae. You've taken away the cherry on top, but the huge sundae is still available. The death of opportunity zones has been greatly exaggerated, to paraphrase from Mark Twain. But the program does have a sunset date of December 31, 2026. That's the last date on which an investor can generate a gain and still have it be eligible for all of the tax considerations that qualified opportunity zone investing can afford. Some facts and figures. Like I mentioned, this is a place-based tax policy. We're going to look at the map on the subsequent slide, but all over the country, there are exactly 8,764 census tracts that have been designated as opportunity zones and are eligible for this type of investment and tax treatment. Roughly 35 million citizens of the United States live within these zones, and the zones cover roughly 12% of the total land mass of the nation. According to my estimates, which I'm basing off of a couple of different surveys and reports, I estimate that approximately $100 billion of equity has already been invested in qualified opportunity funds through the end of 2021. And just to give you some context there, the second biggest economic development program that this nation has is the New Markets Tax Credit program. That program is capped at $3.5 billion annually in a typical year. So this program has already well exceeded the capacity that program has. As promised, here's the map of opportunity zones. You can see that the blue shaded regions are opportunity zones, and they are all over the country here. Each census tract, the Census Bureau likes to have each census tract cover roughly 4,000 citizens, 4,000 population. So in the rural areas, they're a little bit bigger, and in the denser coastal metropolitan areas, they're much tinier and closely packed together. And you can see that each state has a fair number of opportunity zones. There's over 800 in California. There's several hundred in Texas. There may only be about 25 or so up here in the Dakotas and Montana. Puerto Rico down here in the bottom right got a special carve out. They were able to designate not just 25% of their low income census tracts, but actually 100% of their low income census tracts. That was to help with the hurricane and earthquake recovery efforts. So as a result, nearly the entire island of Puerto Rico is designated as an opportunity zone. And we've also got some few dots here for the US Virgin Islands as well. Apologies to Alaska and Hawaii and Guam and some of those other places. They also have opportunity zones. I couldn't fit them all on the map. Some technical terminology that you don't want to get tripped up on. We'll go over very quickly here. So a QOZ or an OZ, I like to call it OZ. Some people say Oz. I've always been an OZ pronunciator, but it just refers to the qualified opportunity zone itself. Sometimes this term gets conflated with the funds who are raising capital. Like, hey, can I create an opportunity zone? Or hey, do you have an opportunity zone I can invest in? The zone, qualified opportunity zone, QOZ or OZ, really just refers to this particular boundary here, right? The boundaries that are shaded blue on this map. A QOF, or sometimes it's referred to as an OZ fund, or some people will pronounce QOF as QOF, refers to the Qualified Opportunity Fund. It's the investment vehicle through which all capital gains have to be deferred into in order to receive the preferential tax treatment. I'll talk a little bit more about qualified opportunity funds a little bit later in the presentation today. And we've got these more esoteric terms, QOZP, QOZB, QOZBP. We could probably spend a half an hour at least just on these three terms, but suffice it to say, these are the assets that lie within the qualified opportunity fund, typically qualified opportunity zone property and businesses and business property. And then 1400Z is the Internal Revenue Code section that defines opportunity zones and qualified opportunity funds. So we'll shift gears here now. We'll take a look into the actual tax benefits that apply to an investor who has triggered a capital gain, how he or she can take advantage of opportunity zones and the tax benefits that await him or her. There were three main benefits when this program was first rolled out. As I mentioned a few slides ago, this is a perishable tax incentive, and as such, benefit number two has actually already completely expired. This was a reduction period, which was eligible for investors who made investments prior to 2019 or prior to 2021. Those windows have now since closed. I like to keep that benefit up on this slide just to explicitly be able to say that that benefit is no longer with us. Just in case you're referring to older material that you might find on my website or anywhere else online or in any other type of material, you'll see these three benefits. Just know that benefit number two, the reduction benefit, has expired. But essentially, an investor who triggers any type of capital gain, and the beauty of this program, unlike a 1031 or a DST, is that the gain does not have to come from real estate. It can come from the sale of stocks or bonds or Bitcoin or collectibles or artwork or privately held business. Any type of capital gain is eligible for deferring into a qualified opportunity fund. And the two benefits you get now are, one, a deferral period. You get to defer recognition of the gain until December 31, 2026. It's essentially, at this moment in time, it's roughly a 5-year interest-free loan from Uncle Sam. That benefit is getting reduced in value every day that we get closer to that date, right? If you make an opportunity zone investment in December of 2026, that benefit's pretty much worthless. But for the next few years, at least, it does equate to an interest-free loan from Uncle Sam. Benefit number two, I talked about, it's already expired, so we won't really cover it any further. Benefit number three is that tax-free growth benefit, the elimination of all capital gains within an opportunity zone investment, so long as you hold for at least 10 years. So let's go through an example, and I'll pause here just to say, for anybody who is joining us a little bit late, we do have a Q&A tool in our Zoom toolbar. I already see a couple questions coming in. If you have any questions for me, we are going to hold those questions until the end of today's presentation, but feel free to use it throughout the course of the presentation. We'll hold some time at the end to try to get to as many of those as we can. So let's walk you through an opportunity zone investment example. Let's say you have a client, US taxpayer, who has triggered a capital gain recently. Let's say the capital gain is $10 million. We'll assume standard 20% federal capital gains tax rate plus the 3.8% NIIT rate, 23.8. We're going to ignore state taxes just to keep it simple. So normally your client would owe $2.38 million tax liability due the following April when he or she files his or her timely filed tax return. It would leave that investor with just 7.62 million net to play with, to invest, to put into some other product or whatever your client would want to do with it at that point in time. Instead, let's have your client, within 180 days of triggering that gain, rolling over the gain amount and the full gain amount, $10 million, not the after-tax amount, into a qualified opportunity fund. So two main benefits. We'll go through all three actually, but just know again, number two is expired. First benefit is that deferral period. So it's essentially an interest-free loan of $2.38 million from the federal government until April of 2027. So it's still about 5 years at this point in time. The benefits here are that's just that much more additional capital that you're putting to work into the investment that you're putting it in, just a greater amount of compounding over a greater number of years. Now, the important thing here to note, once again, is that the tax does eventually come home to roost, excuse me, on that initial gain. And huge caveat here, there is a little bit of a tax rate risk associated with this benefit. You're not going to pay the tax rate in the year that you actually trigger the gain. You can't lock in today's rate. You are going to pay at the 2026 rate. And there's likely going to be a tax rate increase between now and then. What capital gains tax rates are going to be in 2026 is anybody's best guess. And I would urge caution here. We don't know who the president is going to be in 2026. We don't know what the makeup of the House and Senate is going to be in 2026. So this is just highly speculative. I wouldn't really worry about that particular risk too much. I think it gets overblown a lot, and there's a lot of hand wringing over that by investors and advisors alike, which I think is a little bit unwarranted. And in fact, if rates go up, the full benefit of this program actually increases in value in the long run. And we'll see why when we get to benefit number 3. Benefit number 2, there was a reduction that was available up through the end of 2021. It's since expired, but essentially you got to reduce the amount of gain that you recognized on your 2026 return when that initial gain comes home to roost by up to 15%. That expired at the end of 2019, or up to 10% that expired at the end of 2021. Essentially, you had to achieve either a 5 or a 7-year holding period within the Opportunity Zone Fund prior to the end of 2026. And since we're now within 5 years of that end date, these benefits have essentially expired, although, and we'll touch upon this at the end, there is some pending legislation that may reopen this window. So that's another reason why I like to keep it in this deck. Number 3, this is the big one. This is the main part of the hot fudge sundae, so to speak. It's the elimination of all capital gains tax liability within the Opportunity Zone investment after achieving a 10-year holding period. Essentially, you pay no capital gains tax again from that OZ investment. Tax-free growth, it's a super Roth IRA or a 1031 exchange on steroids. So let's say in our example, we hit a home run. Our $10 million gain appreciates to $50 million 10 or 15 or 20 years from now. Normally, a $40 million capital gain is going to incur a 8-figure tax bill, right? And that's just from Uncle Sam. You've got some state tax considerations there too in a lot of states. In this case, you owe nothing. There's just $0 of tax owed on that $40 million gain. Now, an important note here, according to the current regulations, the gain must be recognized by December 31 of 2047. You have to either divest of the property by that point, or there may be a method by which you can do a mark-to-market and pay taxes, or not pay taxes, but to reset your cost base at that point in time, it's a step up to fair market values is what technically happens at that point in time. But I would caution that's still 25 years out, and the regulations are likely to change between now and then. So, but currently it's through 2047. And again, if the tax rate goes up between now and then, doesn't this make this incentive much more valuable? Where else are you going to put that $10 million gain to work? If you put it to work in any other type of taxable account, you're just going to be paying a lot of capital gains taxes one way or another on the back end. This allows you to shield them from capital gains taxation. So, I mean, unless you have access to some other sort of tax-free vehicle, this is a very compelling program to take a look at. Okay, so shifting gears here now again, a program that this is often commonly compared to is the Section 1031 exchange, or a Delaware statutory trust investment. An investor who has a real estate gain can often take advantage of these programs and they offer similar benefits. I would say one of the most important distinctions between these two different types of programs is the 1031 exchange has been around for over a century. So there's a lot of muscle memory and there's a lot of knowledge and comfort around 1031s. And DSTs have been around for quite a while now too, not 100 years, but they've been around for quite a while. Opportunity zones are still new. Like I said, the legislation was only passed 4.5 years ago. The zones were only finally designated just under 4 years ago. There's still a lot for the investor community, high net worths, ultra high net worths, family offices, and their advisors are still kind of getting up to speed on opportunity zones. So it actually is a very compelling opportunity to get in as an early mover, but there is a little bit of a learning curve, and I'm hoping that today's presentation kind of helps get a lot of people at least partly through that learning curve. But we'll go through each of these rows one by one. Again, I touched upon this earlier already. The full tax benefit timeline for opportunity zones, you need to achieve a 10-year holding period, and that's it. It's you don't have to die like you do with a 1031 exchange, where the main tax benefit really kicks in for your decedents upon death, with the fair market, with the step up to fair market value for your heirs. Now, 1031s do allow, of course, an indefinite deferral of capital gains, where you can sell an appreciated property and defer the gain, defer into or exchange into a new property, appreciate that, exchange again. You can chain together those exchanges over decades, really, and that's quite valuable. But with opportunity zones, the whole kit and caboodle can be achieved within 10 years. So we'll leave it at that. Triple net leasing is very common with DST exchanges, with DST investments and with 1031 exchanges. It's fully allowed there. It's oftentimes quite a popular type of 1031 exchange, is to just continually 1031 exchange into triple net lease properties, CVS or a 7-Eleven type property, strip mall type property, and just kind of set it and forget it, get a bunch of cash flow in. With opportunity zone investing, the IRS has actually really handcuffed us on triple net leasing. It's technically not allowed. I would say it is achievable in limited fashion. I could probably spend half an hour just on triple net leasing strategies within opportunity zones, but suffice it to say, it's just extremely limited the amount of triple net leasing you're able to do within an opportunity zone investment. Capital gain eligibility is a huge difference between these two. Like I said before, if your client has a non-real estate gain, really opportunity zones are the only place that you can look into to achieve these types of tax deferral treatments and capital gain elimination treatment on the back end of the subsequent investment. If your client has a real estate gain, then you may want to look at both of these and make some comparisons. 1031s, of course, has to be a like kind exchange, real estate into real estate. Opportunity zone investing can come from any type of gain, and the qualified opportunity fund doesn't always necessarily hold real estate. The vast majority of the time it does. But the qualified opportunity fund can be used to invest in startup businesses or new businesses moving into an opportunity zone, so operating businesses essentially. The investment amount, this is a really interesting difference between these two different types of programs. With a traditional 1031 exchange or a DST, the principal and the gain, the entire proceeds essentially from the sale have to be rolled over into a new property or DST investment in order to achieve the full benefit. Otherwise, you've got issue with dealing with the boot. With an opportunity zone investment, you can be a lot more flexible. Only the gain is eligible for the preferential tax treatment. So let's put some more numbers around this. Let's say our $10 million gain example, let's say that came from a $30 million sale. So $20 million basis, $10 million gain. With a DST or 1031 exchange, you got to pour in that whole 30 million in order to achieve the full benefit. With opportunity zones, you can take the $20 million principal off the table, and now you've got the $10 million of gain that you can play with. And you don't necessarily have to put the whole $10 million to work. If you want to take some off the table and pay capital gains taxes on it now, that's okay. Maybe you want to do 5 and 5. Maybe that's that could be part of the investment strategy there. It just allows for a lot more flexibility. You can take a lot of liquidity off the table with an opportunity zone investment, which is one of the reasons what makes it so compelling. The focus here, we'll move to the focus, and I'll get to this in a little bit more detail a little bit later in the presentation. But with an opportunity zone investment, just the way that, because of the policy goals of opportunity zone as a tax policy, the entire program is meant to stimulate new development or redevelopment or bring new businesses into these economically distressed areas, these opportunity zones. And as such, you can't just buy and hold a property. You can't just buy and hold a cash flowing multifamily building. You can't just buy and hold a piece of land and as a speculator and then flip it 10 years later. You can't just buy and hold a parking lot. You have to, with an opportunity zone investment, in order to meet the compliance requirements, you have to do ground up construction or substantial redevelopment or bring in startup businesses or new businesses into a zone. That differs a lot from a traditional 1031 exchange, where you're sometimes you're buying into a multifamily property or a duplex that might need a little bit of work and maintenance, but usually you're not doing substantial improvement on it. With a DST, you're actually restricted in the amount of improvement you're able to do to a property. So typically, you're coming into a stabilized asset that's already cash flowing. So with opportunity zone investing, it's much more opportunistic. Your goals there with an opportunity zone investment are really capital appreciation. Whereas with a 1031 exchange or a DST, your goals are cash flow or capital preservation, a little bit capital appreciation as well, of course. To be expected, but for the most part, those are the two main differences there in the focus. I'll touch upon that a little bit more, a little bit later in the presentation. Just to answer a couple questions I'm seeing in the chat here. One question from Juan, he asked, can we get a copy of the slides for future reference? So anybody who's joining us late, I am going to offer this deck for download. You'll be able to download it. I'll have instructions for how to do that at the end of the presentation today, and keep those questions coming. I'm seeing a lot coming in through the Q&A tool. I'm holding all those until the last 5 or 10 minutes of the presentation today. But thanks for your patience and keep those questions coming. Timeline for investment, very similar in that they both, essentially you have to have the investment completed within 180 days of triggering the sale or gain. But the main difference here is with a DST investment or a 1031 exchange, you have a 45-day rule where you have to identify the replacement property within 45 days. One interesting thing to note here is that if you somehow, for whatever reason, blow through that deadline, and that happens sometimes when you're trying to do a 1031, sometimes you blow through the 45-day period. It's too tight a time frame. You don't have luck finding the replacement property. You can actually use an OZ as a rescue vehicle for that gain. It can sometimes rescue a failed 1031 exchange because you blow through the 45 days. You still have 135 days left of the 180 to roll over that gain into an OZ. So that's just something else to consider. Ease of investment. A couple of differences here. the opportunity zone investing, it's much easier to get going initially. You can either start your own qualified opportunity fund. I'll talk about that a little bit later on. And the process by which you do that is you simply just self-certify with the IRS, or you can just simply write a check to a qualified opportunity fund, a third-party qualified opportunity fund, and be done with it. Whereas with a 1031 exchange, you need to work with a qualified intermediary. There's just a little bit more of a hurdle to get going. Now, I would say on an ongoing basis, maybe 1031s and DSTs are a little bit simpler, especially if you are the investor doing your own QOF. There's more compliance hurdles for QOFs on an ongoing basis. But I'll talk about that a little bit more. And that row's not in here. I probably should have a row in there on compliance, but we'll get to that next time. Geographic restriction, this is a huge one. There's no geographic restriction for 1031s or DSTs. And of course, with opportunity zones, you're primarily limited to the 8764 census tracts, most of which are low income tracts. Some other considerations, I touched on this, as OZs can be a fallback for a failed 1031. A couple more things to consider. What's going on with section 1014? That's the step up basis upon death to the investor's heirs. Is that potentially in jeopardy? A year ago, it certainly looked like it was. Biden administration wanted to handcuff that program quite a bit, but that legislation never went anywhere. But if something like that gets passed in the future, then that could severely limit DSTs and 1031s and their ability to have that full tax benefit of capital gains avoidance upon death. And another consideration is, are OZs here to stay? It looks likely that they are. They've been written into the Internal Revenue Code statutorily. Is that a word? Yeah, I think so. And there is some pending legislation that would extend them and kind of strengthen the program a little bit more. So we'll get to that a little bit later. Shifting gears again, this is a federal tax incentive program, as I've mentioned a couple of times, but the vast majority of states also either A, fully conform with the federal incentive, or B, they don't have capital gains tax rates to begin with, and then you don't have to worry about anything. But most states do conform with the program. There are a handful that do not. So just be aware, if you have clients or if you are an investor yourself and you have nexus in any of these 5 states, California, Massachusetts, Mississippi, New York is a recent one. They actually just passed legislation last year that decoupled New York from the program, or North Carolina. Just know that you're still eligible for the entire federal tax incentive, to be clear. If you're a California resident or you have nexus in the state of California for your opportunity zone investment, you're still good to go for the federal, but you are going to be facing this tax burden or headwind. In parentheses here, these are the capital gains tax rates as of this tax year, 2022, at the top marginal rate. So the ultra wealthy in California are now paying 13.3%, although I think that kicks in at a pretty high income amount. So you might be a little bit under that, but it's still pretty high regardless. And New York, another high one. California and New York, interestingly enough, were the 2 states that received the most opportunity zone equity flow over the last couple of years. So they're not struggling to get opportunity zone equity, but it is a headwind if you have nexus there. So we've talked about qualified opportunity funds already a handful of times throughout the course of today's presentation, but wanted to dive in a little bit more and talk about what they are and your options with regards to investing in them. And again, just to make it clear, opportunity zone investing, in order to fully comply with the program and to receive all of the preferential tax treatment that is afforded to investors of the program, your capital gains need to be rolled over into an entity that specifically elects to be treated as a qualified opportunity fund, as defined in Internal Revenue Code section 1400Z-2. You cannot simply buy a property directly in an opportunity zone and expect it to qualify. You can't expect a new business venture that you start up in an opportunity zone to automatically qualify if you just pour money straight into those entities. The capital has to flow through a top level entity that is organized as a qualified opportunity fund. So just to be clear there. And you really have two options. Your clients have two options. You can create your own qualified opportunity fund, and there's some pros and cons doing that, or you can invest in a third-party qualified opportunity fund, and there's pros and cons to that as well. So let's look at both of those. So creating your own qualified opportunity fund, or sometimes I refer to this as a self-funded qualified opportunity fund, or a captive QOF. This is really geared toward either extremely wealthy individuals or individuals who have expertise or access to direct deal flow, who can have and who want hands-on management and operations of the underlying assets of the qualified opportunity fund. Some benefits here are you get more control, and you don't have quite as many fees layered into your investment. You can invest into your own projects if you have a startup business, for instance. You might want to start your own QOF on top of that, just as like a top layer structure. If you have a new multifamily deal that you're developing and it's in an opportunity zone, this would be pretty beneficial for you. You can also sometimes, particularly if you have a large amount of capital, several million or tens of millions of dollars in your own QOF, you can come in with a little bit of more control and oftentimes partner with other established qualified opportunity funds and invest alongside them directly into the projects. Of note here is that fund of funds are not allowed. So qualified opportunity fund, you can't simply fund your own qualified opportunity fund and then deploy the capital into somebody else's fund. You have to go directly into projects. There is pending legislation that could change that, but for now, that's the rule. It's very easy to create your own fund, and especially if your time clock is ticking, if you triggered your gain 170 or 175 days ago, you can get your own fund up and running within a day or two, sometimes that very same day. I have actually partnered with a service that does that. And if you are running up against a deadline, reach out to me and I'll point you in the right direction. But it's very easy to create. You simply self-elect with the IRS annually with IRS Form 8996. There's no qualified intermediary you have to work with. There's no approval process you have to go through with IRS or the CDFI fund or the Treasury Department or any of that. You just raise your hand every year when the entity's tax returns are due, typically in March or April, depending on what structure you use, with IRS Form 8996. That's it. Now, ongoing, there is a compliance burden. There are some compliance hurdles that you have to adhere to. And there's also a burden of actually performing the capital deployment. The funds can't just sit in a bank account indefinitely. You have typically, and I won't get into the specifics because it kind of lies outside the scope of this broad overview of OZs, but typically you have about 6 to 12 months to actually deploy the capital into tangible property. The other option, if you don't want to set up your own qualified opportunity fund, is you can invest in somebody else's qualified opportunity fund. And there are hundreds, maybe thousands, but certainly several hundred such funds that are open to outside investors and currently raising capital. It's just similar to investing in any type of private equity fund. And there's a variety of different flavors, so to speak, or investment objectives or goals or strategies, similar to, the universe of mutual funds or ETFs. If you can think of a strategy in terms of real estate investing in an opportunity zone, there's probably a qualified opportunity fund that exists for it. Some funds are single asset funds and invest in, let's say, for example, just one multifamily property in downtown Portland, or one hotel asset in Puerto Rico, or one office complex in San Jose, California. Those are single asset deals. Sometimes you'll find funds that are multi-asset and more diversified. They might be diversified within one particular sector, holding maybe 4 or 8 or 12 different multifamily properties all over the country, sometimes geographically focused in the Pacific Northwest or the Southeast, for instance. Sometimes you'll find multi-asset funds that are diversified across a broad class of different sectors, some multifamily, some hospitality, some mixed use, some office. So depending on what your investment objectives are, depending on what your goals are, depending on where you see the market going or where you want your clients to be, there's a lot of different qualified opportunity fund offerings that offer a lot of different investment strategies out there. The vast majority of them are private placement offerings that are offered under Regulation D. I have seen a couple of qualified opportunity funds that are offered under crowdfunding Reg A or A+, but the vast majority of the time, these are private placement offerings under Reg D, typically offered under Rule 506B or 506C. If you're a securities law nerd, you might know what I'm talking about. And if not, don't worry about it. It's not terribly important. That was for my securities law nerds in the audience there. Raise your hand if you're one of them. Things you want to consider when you're investing in a third-party QOF: one, who is the operator? Who are you getting into bed with for the next 10 years? Because this is a long year. This is a long-term hold. You want to make sure that you're with a steady operator that you can trust. In most cases, these funds are limited to accredited investors only. And there are fees to consider as well. They're typical of most other private equity funds. You'll get usually a 2 and 20 structure, for instance, is pretty typical. Sometimes you'll see asset management fees as low as 1%, maybe less than that actually, but 1 to 2% a year is a typical asset management fee. And then you'll typically have a preferred return for limited partners. I see prefs in the range of 6 to 10%. Typically, I'd say 8% is about average right now. And then oftentimes they'll have a waterfall structure where, it'll be a 20% carry at 8%, maybe 40% carry at 10, and then split 50-50 at 12 and up. By the way, that's just one example. These are structured all sorts of different ways. And the fee structures, I've never seen two funds that are structured exactly the same in terms of their fees. So, and it's quite difficult to compare the fee structures sometimes, but that's another question to ask or to look into, is what is the fee structure? And then as a limited partner who's just writing a check and setting it and forgetting it to a qualified opportunity fund, your tax filing burden is simply filing IRS Form 8997 annually. I'll go back to the previous slide. Remember, QOFs file Form 8996. Limited partners or investors in QOFs file Form 8997. I'm going to talk a little bit more about the Qualified Opportunity Fund, what it's designed to do. We touched upon it at a high level. I'll go into the weeds a little bit more now, but stay out of the real weeds, because again, I mean, you could probably spend at least a couple hours, if not a whole day, talking just about this structure. I'm going to try to cover the broad strokes in the next couple of minutes here. Again, the statute created this new investment vehicle. This thing didn't exist prior to the end of 2017. And in fact, the first qualified opportunity funds didn't really start hitting the marketplace until 2018 when the zones were certified by the IRS. This type of investment structure, this vehicle, qualified opportunity fund, is regulated by the IRS. And the IRS is adhering to, or they've regulated this investment vehicle such that it tries to achieve the intended policy outcomes. So again, the policy is designed to spur economic development, drive private capital into these economically distressed communities that have traditionally lacked access to private capital. So there's a number of requirements that you need to hit in order to qualify as a qualified opportunity fund, so that the investors in the fund are eligible for the tax benefits. Again, you can't just buy and hold a cash flowing property without improving it. You can't just buy and hold a piece of land or a parking lot. You need to spur real economic activity in the zone. So there's a lot of requirements. I'm just going to touch upon two of the most important ones. One is a 90% asset test. And essentially this is stating that 90% of the assets in the fund have to be deployed into real property in qualified opportunity zones. You can have up to 10% not qualify. In fact, you can have a portion of that 10%, I think it's 5% overall, in non-qualified financial property. But suffice it to say, you can't just hold cash or other instruments. You can't just let the money sit there within and I don't want to get in the weeds here because it's kind of beyond the scope of today's presentation, but typically within like a 6 to 12 month period. And that you can buy yourself more time than that if you have a working capital safe harbor business plan, but typically you need to deploy the assets in some sort of timely fashion. into tangible property located in these opportunity zones. The second most important requirement in my mind is the original use or substantial improvement provision. This either has to be new construction or a new business investment coming into this area, creating more jobs, increasing the local tax base, or you have to substantially improve an existing structure, an existing property. Really quickly to define that, substantial improvement they had to define in the regulations, and it's defined as doubling the basis in the property. And for the purposes of real estate property, you get to discount the value of the land when you make that substantial improvement. So an example, let's say you have a $1 million property that you acquire, you get it assessed, $300,000 is how the land is valued and the building is valued at $700,000. You have to put more than $700,000, more than the value of the building, into the property over a certain time period in order to meet this requirement. So a lot of the funds that I have seen, particularly multifamily funds, multifamily seems to be the most popular sector within real estate for doing this type of investment. They're not even bothering with substantial improvement. It's just ground up. It's just a lot easier to hit that original use requirement. There's a few funds and opportunity zone deals that do substantial improvement, but the vast majority are just doing ground up construction. And QOF, again, it just self-certifies to be treated as a QOF with IRS Form 8997. It has to be a regarded entity, though. Typically, an LLC, it has to be a multi-member LLC. You cannot do a single member LLC because that's a disregarded entity and it's not going to get its own EIN. Or I think actually you can get an EIN with a single member LLC, but everything just passes through to Schedule C on the individual's tax return. I'm not a CPA, so I just know it can't be a single member LLC, but it can be a multi-member LLC or an S Corp or a C Corp. Sometimes it could be structured as a REIT. And in terms of the number of these funds available, there's thousands, if not tens of thousands of them out there. And there's really no limit on the amount of capital that can be raised by these funds. We're getting toward the end of the presentation here. I'm gonna stop in just a couple more minutes and start taking these questions. I wanted to cover some investor risks for you to consider for your clients. Just some food for thought. There is a tax rate risk. We covered that already. Capital gains rates could go up, but I feel as though that mitigates additional risk in the future. If capital gains rates do go up, I actually think that's a good risk, for lack of a better term. Market risk, the tax benefit could move the market potentially. This was a concern at the outset of the program. And in fact, there was some research conducted in 2019. The data for it was a little bit dubious, but it showed that, all else being equal, properties located in opportunity zones were selling for much higher rates than properties located outside of opportunity zones. So is there a risk of overpaying just because it's an opportunity zone property? Also, there's the timing of the sale. The first set of qualified opportunity funds are going to fully mature, so to speak, or hit their 10-year mark in the middle of 2028, a few years from now, 2028, 2029. Think of where the market might be at that point in time when those funds need to divest or sell those properties in order to pay their investors. By the way, there's nothing that says that a fund or opportunity zone asset owner has to sell after 10 years. In fact, there's one school of thought you can follow that would say maybe you should try to hold the investment for as long as you can. Don't worry about trying to sell it after 10 years on the day and getting your money back quickly, because, well, then where are you going to put your money? You want to let this thing eat for as long as possible. Again, think of it as a super Roth IRA, but that's another consideration, some market risk. I don't know if that's much different than any other type of real estate investment or any type of investment really, but there's a little bit of market risk there. And then finally, liquidity risk, and this is specific to opportunity zones. There is some liquidity that you'll need to pay your tax bill on that initial gain when it comes due in April of 2027. Let's see, got a couple more minutes here. I'll go through a marketplace update. At the outset, I estimated that $100 billion of OZ equity has already been raised as of the end of 2021. I'm basing that estimate off of two research reports. One is from Novogradic's QOF survey. which was updated in Q1 of 2022. It shows that roughly, I can't remember the number now, I think it was about $25 billion or so had been raised through the end of Q1 of this year. The problem with their survey is it's incomplete data. They actually estimate that the real number, they're only surveying a portion of all the qualified opportunity funds in existence. It's a voluntary rolling survey. And they estimate the real number is probably 3 to 4 times their number. That gets me to 100 billion. There was also a report on opportunity zones conducted by the Government Accountability Office, the GAO, which showed $20 billion plus had been raised by qualified opportunity funds through tax year 2019. That data is complete, but it's out of date. They take a few years to kind of crunch all those numbers. So that's the most recent year we have numbers for. But if, I don't know, I'm kind of, it's a little bit of a fuzzy estimate, but I think it's not out of the realm of possibility that $100 billion has already flowed to this program. And if you consider that it's, you know, only one part of the equity stack and only one part of the overall capital stack of certain projects, if you throw in different types of debt and other types of equity, it's not out of the question to consider that there might be roughly $500 billion of opportunity zone projects in existence already today. Quick legislative update, and then we'll kind of wrap up here. There has been some proposed bipartisan legislation that was introduced in April of 2022, just a few months ago. It's called the Opportunity Zones Improvement, Transparency, and Extension Act. It was sponsored by the original co-sponsors of the original Opportunity Zones legislation back in 2017, namely on the in the Senate, Senators Cory Booker on the Democratic side and Senator Tim Scott on the Republican side. Those are the two main Senate sponsors, co-sponsors at least, and a lot of other co-sponsors from both sides of the aisle and in both the House and the Senate have backed this bill. So I think this is the legislation that has the best chance of being passed at some point, hopefully later this year, maybe next year, but it's going to do the following. It would extend the tax incentive for an additional 2 years. So we have currently that 2026 end date. That would push the end date back to 2028. It would reopen that benefit number 2, the initial gain reduction. It does so in a couple of ways. One, by pushing that end date back to 2028, you reopen that 5 and 7 year time window. Well, not the 7, but you reopen the 5. But it also is envisioning that you wouldn't have to achieve a 5-year holding period, but rather I think it's a 4 or 6 year holding period in order to get that benefit. Suffice it to say, there's a couple different ways that this benefit reopens, and depending on when this legislation is passed, it could kind of change which of those benefits is open. So this one's to be determined still, but there's a road whereby benefit number 2 would reopen up. It also would expand some reporting requirements that the funds and investors would have to relay to the IRS, essentially just making those forms, Form 8996 in particular, just collect a little bit more information. It would also decertify some opportunity zones, some of the high income opportunity zones that have attracted some negative headlines, although there is a grandfathering provision in this proposed legislation. So if you have already invested in those zones that get decertified or early sunsetted, you'll be okay. And it would allow for that fund of funds concept that I spoke about before. When it comes to applying opportunity zones to a client's portfolio, some considerations. If your client has low basis and high gains locked in from the market run up of the last 10 to 12 plus years, this is worth a look. You might be sitting on some high stock gains despite the drawdown that we've experienced over the past several months, and in particular the past week, right? But there's still probably a lot of low basis gains locked in. This can allow an opportunity for some diversification, pulling some chips off the table without triggering that immediate huge tax hit. I would encourage you, if you use an investment platform through your firm, through your RIA, if you're an RIA or you're employed by an RIA, you often will be, or you probably use some sort of platform that may already have qualified opportunity funds pre-vetted on it. So I would start there. And remember, overall, OZ investing is opportunistic. It's for capital gains only, and the focus is on capital appreciation. So we've got some resources on our website that I would encourage you to check out. In addition to whatever platform you're working on through your group, you can research a lot of qualified opportunity funds that are open on our website at opportunitydb.com/funds. We also have OZ Pitch Day, which we host 3 times a year, and we've got one coming up here at the end of July, about 6 weeks from today. You can learn more about that event where we highlight a lot of education on opportunity zones, panels like this, but also we showcase a lot of open, privately placed qualified opportunity funds that are seeking capital. You can check that out at ozpitchday.com. And then if you listen to podcasts or you watch YouTube, find us, do a search for Opportunity Zones podcast. I host that every week with a different expert guest. I'm going to stop there and take some questions. And let's see, we've only got 3 minutes left in the hour, so I might end up going over. If you want to stick around, that'd be great. If you got to bounce at the top of the hour, I won't hold it against you. If you'd like to download the deck, if you missed anything, if you joined late or you just want to review it, you can download this deck at opportunitydb.com/advisors, or you can scan that QR code and that'll take you there as well. For certified financial planners who are looking for the CE credit, stick with me for 1 or 2 more minutes. I'll flash up that URL where you can take the quiz to qualify for that 1 hour of CE credit. And actually, I think the link to the quiz is available on that webpage there. Some questions here. We'll get to some questions for a few minutes. I'm probably going to go over an hour here. I've got some time after, but I'll answer as many questions as I can in the next few minutes. Carmen asks, how do you find the list of census tracts? Sometimes the map doesn't show clearly the boundary of the QOZ. That's a great question, Carmen. So I have a list on my website. Let me actually stop my screen share here for a minute and see if I can find that list, and I'll share the link. I also have this list in Excel spreadsheet format. So Carmen, and for others, I'm going to actually put a link in the chat right here. So that's opportunitydb.com/zones. That has a list of all 8,764 zones, and you can filter by state or by, you can filter by population, square miles. There's a whole bunch of different ways you can slice and dice that. That's a great question, Carmen. Thanks for that. I did want to, let's share my screen again here. And I did want to, before we do hit the top of the hour, make sure that any CFP holders who are waiting for the quiz link, this is the link where you can take the quiz and qualify for that 1 hour of CE credit, opportunitydb.com/CFP quiz 01. This is all one word, or you can scan this QR code and it'll take you to the quiz. Whoops, excuse me there. Let me go through some more questions here. We have hit the top of the hour. So if you want to bounce off this call, I won't hold it against you, but I know I've got a lot of questions here. I'll go for another 5 or 10 minutes and get some more of these questions answered. Barbie asks an easy question. Would you please send this PowerPoint to us? So yes, you can go to, I think Andy just posted the link in the chat, opportunitydb.com/advisors. You can download the deck there. Thanks for that question, Barbie. Let's see. Anonymous asks, do you have to invest the proceeds or just the amount of capital gains to realize the tax benefits? Great question. Yeah, with a 1031, you do, right? But with an OZ, you do not have to invest the proceeds. You just have to invest the capital gain to realize the investments. And you don't even have to invest the full capital gain. It can be a portion of the gain. So if you have $30 million sales proceeds, $10 million is gain, you can invest up to $10 million would be eligible for that preferential tax treatment. And you can invest as much or as little as that as you want. You don't, and then that $20 million of principal from the proceeds is cash you can do anything with. It's just available for playing with however you want. Hope that answers that question. Let me see some other questions here. Let's see, can you discuss the status/effect of Biden administration's recent 2-year extensions we've read about recently? So I did cover that. This is a question from Darren. He asked that question early on. I did cover that a few slides ago. If you download the deck, there's a little overview there again. Just to be clear, that 2-year extension did not come from the Biden administration. It came from The Senate and the House co-sponsors of the bill. But we did cover that, so I won't go into any more detail there, but there's some more detail on the deck to download it. Let me go back to that download slide here. If you want to download the deck again, opportunitydb.com/advisors, or you can scan that QR code. Todd asks, why have QOF contributions been limited only to proceeds from the sale of appreciated assets? If the government wants broader participation in QOZs and QOFs, why don't they allow funding by cash contributions from other sources, for example? So Todd, you're speaking my language. I've been wondering this same thing myself for the last 4 years since this thing rolled out. I think the initial policy goals were kind of, the policy makers of this policy saw that, and I'm going to cite a big number here, $6.1 trillion of capital was sitting on the sidelines. And that number corresponds to the amount of capital gains, of unrealized capital gains, that were sitting on the balance sheets of individual and corporate investors as of the end of 2016 or 2017. I can't remember. And I think they wanted to really unlock that capital that had been locked away, unrealized capital gains that had been locked away primarily in the stock market over the periods that ensued after the run-up following the end of the recession of 07, 08, 09. Now, the problem is it does lock out a lot of investors who don't have capital gains from that stock market run-up or the appreciation of other assets. And there is a push by some to eventually unlock other types of capital to invest in opportunity zones. And I'm hopeful that someday that'll come. The legislation, the proposed legislation I touched on toward the end of the presentation actually doesn't address that, unfortunately. I just think they didn't want to make the laundry list too long, but Todd, it's a great question. I think that's part of the answer why is they just wanted to focus on those unrealized gains and try to unlock some value from the stock market and put it into these economically distressed communities. But I think if this program gets extended by this legislation and it gets continued support and renewal over time, eventually, hopefully we do get to that point where non-capital gains dollars are afforded that tax treatment on the back end, getting to eliminate capital gains from the opportunity zone investment. So thanks for that question, Todd. That was a great question. Let's see, here's a question from Jewel. Jewel asks, would we have to pay 10 years of taxes after 10 years, or do we start paying taxes at that point? I'm not sure I quite understand the question, unfortunately, Jewel. 10 years of taxes after 10 years. So I'll try to address it by just kind of reiterating what the benefits are. You start with an initial gain, you roll it over into a QOF. You can defer recognition of that gain until the end of 2026. So in 2027, you're paying taxes on that initial gain. Let's say you sell your Facebook stock and you've got a $1 million gain. You're going to pay tax on that $1 million gain when you recognize it in 2026. You don't have to recognize it until 2026. So you get that deferral period. After holding that, let's say your $1 million investment that comes from that Facebook stock sale appreciates over time within the qualified opportunity fund. 10 years later, you exit, you've achieved that holding period. There's no taxes to pay on that. Now, over time, the qualified opportunity fund may make distributions that are taxable, or it may cash flow maybe some rental income or other type of income that would be taxed at ordinary rates, and you're paying taxes on those regularly as time goes on. But there's no catch up really on 10 years there. Let's see. Let me see if we've got a couple more questions. We've got a lot of questions here. I'm not sure I'm going to be able to get to them all, but I'll try to get to a few more here. Benjamin, let me see your question here, Benjamin. If I purchase an opportunity zone fund now within the 180 days of a gain received on December 31st, does the gain get deferred on the 2021 tax return, or does it show up in 2021? Okay, so in your example, you trigger a gain on December 31 of 2021. And then you have 180 days from that point to invest into a qualified opportunity fund. So we're actually still, what's the date today? It's the, what is it? It's the 16th of June. So I think you have until June 27th or 28th is about the 180-day mark from December 31 for this year. So you actually, yeah, there are still about 10 more days left where you can roll over a 2021 gain into a qualified opportunity fund. So that's the premise of the question. Does the gain get deferred on the 21 return or does it show up in 22? It gets deferred on the 21 return. So on your 21 return, when you file, and you may have already filed, so you may have to submit an amended return, or if you extended, get it straightened out when you file before October 15th of this year, you would essentially report your 21 gain on Form 8949 typically. And then alongside 8949, you file 8997 with your 21 return. And that shows that you have rolled over that gain within the appropriate time period into a qualified opportunity fund. That was a great question, Benjamin. Let's see. Van Han, let's see if I can get to your question. Van Han Win asks, can I contribute my already owned real estate property located in the OZ to the OZ fund, then improve it and get it tax-free after 10 years? That's a tricky one. So there is a related party stipulation that severely restricts related party transactions. So short answer is no. Long answer is there may be a way around that. And I'm actually going to post my email address in the chat right now. If you email info@opportunitydb.com, if anybody wants to reach out to us at opportunitydb.com, if you can submit that question to that email address, I will pass you off to an expert or a specialist who will help you structure that. Sometimes there's a way to do a lease back to the OZ fund, but that's a little bit above my pay grade, being able to answer that question. Great, good question there. Let's see. We're getting short on time here. I don't want to go for too much longer. If I didn't answer your question, again, please feel free to submit it to please feel free to submit your question to info@opportunitydb.com. Let's see, I'm going to see if I can get to Philip's question here. Philip asks, I have gains that were realized in 2020 and invested in a QOF. Okay, that's great. When must the funds be invested by to avoid penalty? What is the penalty if the funds are not invested in the time period? Can you just invest in another project? Okay, so that's somewhat of a loaded question, and I don't have all of those deadlines in front of me right now, Philip, but typically, depending on when the fund was set up, at what point in the year the fund was set up, and at what point in the year the fund took in the capital, the fund has typically between 6 to 12 months to deploy the capital into opportunity zone projects. Otherwise, it does incur a penalty. I cannot remember off the top of my head what the penalty is, but it is essentially reconciled with, if you look at IRS Form 8996, you'll see how to calculate that penalty on there. I would encourage you to do that. You can certainly invest in another project, yes. I don't know that you necessarily need to be tied to one particular project or another. Philip, if you have any additional questions on that, please do reach out to me via email, and I can help plug you in with the right resources there to get that answered. Carmen Hill asks a couple questions about census tracts. Is there any chance that there will be more census tracts? So at the moment, no. Although there's no process by which new tracts can be nominated as opportunity zones, but the legislation, and I'll go back to my slide on the pending legislation. Let's get this out of the way here. The pending legislation, one of the points here would be to decertify certain high income opportunity zones. And if this gets passed as it's currently written, the addendum here is that for each opportunity zone that a state loses due to that provision, the governor of the state gets to nominate a new opportunity zone, a new census tract to be designated as an opportunity zone. So we might see, let's say that this legislation gets passed before the end of this year, we might see at some point next year, some zones being decertified and a handful of new zones being certified newly certified to replace those decertified zones. So the total number of zones will still continue to be 8,764, but you might have a few dozen or 100 or so zones that get swapped, if that makes sense. But it's a little bit too early to tell. It's speculative whether or not this legislation gets passed at all. And also, if it does get passed, certain provisions like that one may be rewritten. So at the moment, no, there are no ways for there to be more census tracts. And then let's see, you asked also, I don't see the link for the census tracts. I put it in the chat. Let me copy and paste it here into this Q&A tool. And then with that, I think we're going to cut everybody loose. There's the link there. And I'll post it in the chat here. You know what? I screwed up the first time. I didn't post it publicly. So there, I've just posted it publicly. Sorry about the hiccup there. OpportunityDB.com/zones is where you can go to find the full list of Opportunity Zone census tracts all over the country. So I hope that was helpful. Again, if you want to download the deck from today, you can head to OpportunityDB.com/advisors. We are 12 minutes over. Sorry for keeping you so long, but thanks for sticking with me. I've been Jimmy Atkinson, founder of OpportunityDB and host of the Opportunity Zones podcast. I hope you've found this presentation today enjoyable. If you have any additional questions, don't hesitate to reach out. You can find us by emailing us at info@opportunitydb.com. Thanks for your attention. Appreciate it.